So it's not clear sort of where to begin. We actually had to erase some of the stories that we were going to mention because it would have just taken too much time to update everybody on everything happening just in the last 24 hours with concerns around private credit. What's the main concern to you?
Well, private credit is experiencing its Roach Motel moment in terms of retail getting spooked. Retail is really worried. Retail's trying to take out more money than you're allowed to take out. But I would say also look at the prospectus. The BlackRock prospectus for the fund that is being redeemed right now. It says on page 1, 5%, and it's up to them whether they even do that. So you should read the paperwork. The problem with credit and a lot of markets over the last 5 years or so of easy money is people just haven't been doing that work.
So do people ever do that work?
Well,
it's on page 1.
But shame on you. I mean, this is one of the things that we always talk about when we talk about private credit. And I've had terminal users like, do people understand what private credit, how this market works? That's an understanding. It's not liquid, right?
It's not liquid. These are long-term investments in direct loans, which, you sign a contract, you agree to lend the company money for, let's say, 5 years, and you get it back after 5 years, plus a premium. Plus, I'll tell you, investment-grade bonds right now, 5%. I'm going to offer you something else for 3 times that.
Right.
What do you have to do for me to get that extra return? Read page 1 of the prospectus. You're going to have to lock your money up, and there will be a penalty, and you probably won't be able to get your money back when you want it.
James, there's locking your money up, and then there's problems. So how do you distinguish between what we are seeing is that it's just not the right market environment yet for private credit, and so it's going to maybe take longer for either the exits, for the returns, and so investors, you got to understand that. Or is there problems somewhere within the lending and the whole process? Like, how do we, and that maybe people are investing, these firms are actually investing in things that aren't so great, and that transparency isn't truly there for investors.
There are certainly problems on the software side, which we're now starting to see. A lot of these loans were made 5 years ago when rates were 0 and the money was flowing and people weren't asking too many questions and leverage was going on pretty high. Now those things are coming up for refinancing. Those companies are in a much more difficult situation. Some of them may be completely replaced by AI, so you're not going to get your money back. We did see BlackRock write off a loan, $25 million in a kind of Amazon-adjacent space. That's $25 million for a very large fund.
Right. The point we made yesterday, not a lot of money for a company like BlackRock, but for, it sounds still $25 million, $25 million.
But it's BlackRock.
And it's going to 0.
The world's largest asset manager.
Yes.
Like there's, to be fair, you put firms in a certain category, and we do that, rightfully so. And so you're like, well, if they missed it, or does every great investor, Warren Buffett would probably say, I've missed some things, right? Like, how do you assess that?
I mean, there's a lot of pick your manager, get the right manager, don't be a tourist, all these things. Use someone specialized, but you're right. When it's BlackRock losing money, then you start to be concerned. But, again, I'd point to the returns. The returns expectations were very high. Sometimes as high as 20%. So, you've got to assume a bit of a loss there along the way. You're going to take some risk. So I think, the whole outcome, the upshot for me would be, on the one hand, curb your enthusiasm about private credit returns. Mm-hmm. They're not going to be 20%. They may be closer to, less than 10. On the other hand, curb your enthusiasm about the growth of this market because it all relies on retail money piling in and getting you to 40 trillion from 2 trillion currently. I just don't think that's going to happen.
Well, to that point, shares of Blue Owl are down more than 60% from the highs just about a year ago on January 24th, 2025. James, I think the question that people have, and this is literally the $2 trillion question, is about Contagion and about to what extent, since you and I, we last spoke to you 2 weeks ago. Mm-hmm. Since you were last on our program, have fears about Contagion, this spreading to other asset classes, this spreading to big banks, has that shifted?
We're seeing more definitely shorts on the BDCs. We're seeing shorts on the credit market as a whole in terms of the CDX, which is the CDS index, which is a liquid way to take a position if you wanted to. We're seeing outflows from some of the ETFs that are related. So there is a fear that starts to feed on itself, that when you start getting big redemptions, then you have to sell not necessarily the bad stuff, but the good stuff to get liquidity, and that results in just a bit of a downward spiral.
I just want to go to BDCs. It's certainly something we've talked about a lot here at Bloomberg for years. The business development companies, where are they when it comes to the private credit market? Like, how much of private credit are BDCs?
Well, it's a big proportion of it, but
Okay.
but they are the only visible side of it. That's why we look at them, because they
There's
actually
some transparency.
There is a bit of transparency there, and it's a growing part of the market. Maybe that growth starts to slow because of what we're seeing right now, but it is a big. If you wanted to get into private credit, that is a decent channel to do it.
How do you suss out if whether or not this is going to be? I mean, a lot of financial crises are credit based, so this is why it's got everybody, their hairs on their neck kind of standing up. So how do you guys suss it out, or like what are you watching? As it feels like every day there are several stories.
I mean, to me, it's an orderly sell-off. It's a repricing of a market that got very, very expensive.
Okay.
Credit has been overpriced for a long time, and now it's slightly cheaper, but every time it gets cheaper, people buy into it. People buy that dip. They get very well rewarded for doing that. So there is a lot of cash on the sidelines that wants 7% yield in a junk bond, because that's a good coupon to get, especially if rates continue to go down. We just don't know that at this point.
Right.
If
Rates go up, will there be more pressure points, more stress?
It will certainly stress out the weak borrowers with a lot of debt coming due because they can't cover those bills. On the other side, it may make private credit even more attractive because that is a floating rate asset. So there's going to be a push to floating. So there are lots of, I think, ramifications, lots of we don't know yet.
Yeah.
Well, sorry, we just have 20 seconds left, but I wonder at the end of the day if when this passes, if sort of a stronger product emerges on the other side.
That would be the hope, that it grows up and people actually
This is a maturing moment.
People actually read page 1 of the prospectus.
You said that so many times.
But it's something
I guess
to
we got
think
to
about,
redefine
right?
print.
As we look to expand the market, right?
Read the small print. Know what you're doing and why you're getting paid more to do it.